Hey everybody, we're going to talk about one of my favorite stocks that is in Berkshire Hathaway's portfolio. Berkshire Hathaway, of course, is the mega conglomerate controlled by CEO Warren Buffett, and they own three main businesses. They have their subsidiary portfolio, companies like Geico, like Duracell, like Fruit of the Loom, like Dairy Queen, about 60 altogether. They also have a lot of cash in their portfolio that they kind of go hunting for deals. And there's also, of course, the stock portfolio. Berkshire Hath Berkshire Hathaway owns dozens of stocks in a portfolio. Many of them are picked out by Warren Buffett himself. He also has a few other kind of helpers doing the job as well. Before we dive into which particular Warren Buffett stock I'm looking at right now, take a minute, click subscribe if you haven't already, and check out the link you see on your screen, fool.com/Frankel. You get the top 10 stocks from my sponsor, The Motley Fool, and it's a great way to support this work I'm doing here on YouTube. Again, that link is fool.com/Frankel. So I'll cut right to it. The Warren Buffett stock that I'm looking at very closely right now is Capital One Financial. COF is the ticker symbol. It's one of the few financial stocks that are in Warren Buffett's portfolio still. Bank of America is the biggest one in the portfolio. There are also shares of American Express and a few others as well. So Capital One is a recent addition to Berkshire's portfolio, and it's a pretty undervalued stock right now, in my opinion. So it trades for about 10 times trailing 12-month earnings, which, to be fair, earnings aren't the best metrics to use when looking at bank valuations. There's a lot of kind of one-time items that can affect earnings. But if you look at the price to book valuation, Capital One is actually trading for less than its book value right now. That's less than the value if you added up all the assets on its balance sheets, subtracted all of its liabilities. It's trading for an 8% discount to the book value right now. So just a couple of highlights on the bank. Capital One's best known for its credit card business, but it also has a large physical banking operation. I actually didn't know this because if you're not in the DC or the Northeast area up there, you might not be familiar with Capital One, but they are one of the bigger brick and mortar branch-based banks up there. They have a pretty big branch network. They're one of the largest regional banks in the country, not just a credit card business. And there's a lot to like about it. They're one of the most efficient banks that I know out of the physical banks that I follow. They have a 54% efficiency ratio. The efficiency ratios with banking is kind of how much banks are spending to generate every dollar in revenue. Most banks are in the 60% range. Lower is better, so 54% is much better than average. Just to give you an idea of the scale and where the credit card business fits in, Capital One has $345 billion in deposits right now. They have $321 billion in loans. Roughly half of those are credit cards. The rest are split pretty evenly between consumer loans, other types of consumer loans like auto loans, mortgages, things like that, and commercial loans. Commercial loans being commercial real estate, business lending, things like that. So asset quality is a big concern right now among investors for good reason. There's a lot of recession fears. There's a lot of fear that interest rate hikes, especially in the credit card industry, are going to lead to more consumer defaults. We have seen an uptick in defaults lately, but it's nothing to be too worried about. With Capital One's business, the credit card net charge-off rate is about 5.3%. So in other words, of every $1,000 of credit card debt that they hold, a little over $50 of it will eventually get charged off because the consumer can't pay it. That's a little bit elevated from historical levels. The company has plenty in reserves. They actually have a little over 7.5% of their credit card loan portfolio in reserves to cover anticipated losses. And I'm definitely keeping an eye on this, but it's not high enough for me to be very concerned yet. It's still well below where it was, say, in the financial crisis era or things like that. And the rest of the portfolio is looking very, very strong. The consumer loan net charge-off rate, that includes a lot of auto loans, is just a little over 2%. On the commercial side, it's about half of a percentage point. And office real estate, which is a big concern right now, only makes up about 2.5% of their commercial loan portfolio. So not a lot of office exposure. That's a big thing that we're watching with other banks. And it's a highly profitable bank, a 6.73% net interest margin, even after all those charge-offs I mentioned, is about twice what banks like JP Morgan Chase and Bank of America see. So highly, highly profitable bank. If you've seen the news lately, you probably know that Capital One has agreed to acquire Discover, their credit card competitor, I guess you'd call them, in an all-stock merger deal. This combines two of the largest credit card issuers. That's kind of the headline. Discover actually has a lot more credit card customers than Capital One, believe it or not. Discover has about 305 million cardholders. Capital One has about 100 million. But Capital One is the much larger bank with about $479 million in total assets, or $1 billion rather, $479 billion in total assets. It's a much larger bank than Discover, so they're kind of they'll be a very large regional bank with about 400 million credit card customers after this is done. But the big value isn't just combining the credit card businesses, it's absorbing Discover's payment network. Discover is what's called a closed loop payment network, meaning that it acts as both the lender and the payment processor, unlike a company like Visa or MasterCard, which just kind of work as third-party payment processors. They don't actually loan any money, they just move money around. The other big closed-loop payment network, obviously, is American Express. Discover is the fourth largest, and by a good margin, they are the fourth largest of the four major payment networks. But having an in-house payment network could be a big advantage for Capital One. There's a lot of efficiency that could happen with this deal. The company, Capital One, expects about $2.7 billion worth of synergies from the deal by 2027. Just to name one, Capital One enjoys a lower deposit cost than Discover. They pay about 3% on average on deposits in interest, compared to 4.4% for Discover. That's just one example. And Capital One will diversify their income stream with their own payment network. They'll get swipe fee income in addition to interest income. So there are still some regulatory issues that need to be worked out. But I think this could be a big, big deal for Capital One, especially with the valuation the way it is. They're planning to move all of their debit cards onto Discover's network, which will save them money. They won't have to pay fees to, Visa, MasterCard, whatever. And some of their credit cards are going to gradually move some of their credit cards over time. And they're a bigger bank, I mentioned. They can invest more in growth of the payment network and Discover's other businesses than Discover could all by itself. Discover's not a small bank by itself. You can see on your screen right now. They actually have a pretty big operation themselves. A lot of deposits, a lot of loans, including credit cards and other types of loans. Not 100% certain this deal is going to close, but even if it doesn't, Capital One is a well-run bank that's very profitable and has that massive credit card business among a very efficient branch banking business. So out of all the stocks in Warren Buffett's portfolio, this is one that is surprisingly cheap and one that is toward the top of my watch list right now. Thanks for listening, and please leave me any comments you have. I'll do my best to answer any of them individually. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.